Returning to one of our top stories now, and the latest monthly inflation update reveals the cost of living rose higher by 0.5% in April, up to 6.8. That further increases the likelihood of a rate rise when the RBA meets next Tuesday, according to many observers. Let's bring in one now. He's a chief economist at AMP, Shane Oliver. Shane, do you think the RBA will move now? Has this number forced its hand?
Look, it significantly increases the risk that they will move again. We don't think it's enough to get them over the line on Tuesday, but I'm also conscious that on Friday, the latest national wage case, minimum wage case, will be announced, and that certainly could be something that tips them over the line. But yes, you'd have to say the Reserve Bank would be concerned about these inflation numbers. The monthly numbers are still not quite as reliable as the quarterly numbers, and we still have a downtrend despite that rise in the month of April. But by the same token, you could argue, and I think this is quite a strong point, that the RBA has already done quite a lot. They've already seen quite clear signs that retail sales are slowing down. We're looking at a slowing in the jobs market. And so all of those things suggest that they should hold back. But I would have to admit, given their concerns about inflation and given the wage numbers to come out on Friday, that risk of a rate hike next month is very high.
Is one of the structural problems here the issue of rent and housing? Given the supply shortage, the demand increasing, it's a structural problem, as one of your colleagues put it to me. It's an inflation driver that's baked in. That'd have to be a big worry.
It certainly is, and it's something that I think we could have avoided. The problem is that we reopened the economy to immigrants very, very quickly, and I think we should have staged that reopening in terms of immigration numbers. We're looking at record immigration numbers this year of 400,000 people. Population growth will be around 2%. It's faster since 2008, 2009. The problem with that is that we don't have the capacity to supply enough homes to the property market to house that number of people. And obviously that means higher rents. It's now meaning higher house prices. And that's a long-term ongoing problem. And it would have made more sense to try and match the return of immigrants to the ability of the housing market to supply property to the industry. And of course, it's all been made worse by developers going bust, given these issues around rising costs and fixed price contracts and so on. So that is certainly a big concern, and will be obviously something worrying the Reserve Bank. They can't do anything about it structurally, but they can do something about inflation. But it does entail hitting the economy with a bit of a sledgehammer in terms of further rate rises.
The RBA, Treasury and the Treasurer have said that the peak in inflation has passed and it's now on the downward trajectory. Does this monthly data change that at all in your view? You've looked at it closely, or is that gradual decrease going to be observed over coming CPI releases?
Look, to be honest with you, I think the downtrend is still in place. The monthly CPI peaked at 8.4%. It's now 6.8%. It often moves around in a bit of a zigzag fashion, given the way the data interacts. For example, a year ago, fuel excise was halved, and that pushed down petrol prices. And then now, of course, that drops out and pushes up the annual measure of monthly inflation. So there is a bit of distortion in there, but I think the broad trend towards lower inflation is in place. Yes, there's a massive, massive problem with rents. That's a horrible situation for people looking for a home in Australia, whether it's to rent or to buy. But by the same token, we have seen quite a sharp deceleration in clothing prices. They're now just up 2% on a year ago. Furniture prices have decelerated dramatically. A year ago, they were a big part of the problem. New housing itself, the cost of constructing a new home is still rising, but the rate of increase is slowing down. So there are signs here that inflationary pressures are receding. Partly that's because of global influences, but also partly reflects the slowdown in the economy that we're starting to see.
The concern that's been raised by some economists is the prospect of soaring wages if that eventuates, and certainly they're pointing to wage decisions coming up over coming weeks. The RBA governor said it's not problematic where wages growth is at and if it continues, but it is problematic if we have no productivity growth. What can be done to drive what has been that sluggish, at times non-existent productivity growth in recent times?
In fact, lately it's been negative. Well, I mean, really, in other words, output per worker has been going backwards. That's not a good thing. You really need a sort of a comprehensive reform agenda like Hawke and Keating kicked off in the 1980s, like Reagan kicked off in the US in the 1980s, and Thatcher kicked off in the UK. And of course, in Australia's case, was continued under Howard and Costello. You've got to look at the tax system, which some have said is no longer fit for purpose. That needs fundamental rearrangement. The industrial relations system is arguably still not flexible enough. There's a lack of competition in key parts of the economy. The services sector is in particular lacks competition in many areas. So there's a whole bunch of things that can be done here, but unfortunately, those things are politically out of fashion at present. And so economists can sort of beat their head against the wall talking about productivity enhancing reforms, but we aren't seeing a lot of it. But that's what you really need to do. You've got to reform the economy, the supply side of the economy, make it easier for business to do things, make sure there's lots of competition. And history has told us coming out of that sort of reform, as we saw in the 80s and 90s, you do get a huge boost to productivity.
And just finally, on the issue of wages growth, we know the Fair Work Commission ruling on the minimum wage is coming up. What's your broader read on the issue of potential wage increases and that flow-on effect in what is clearly a high inflationary environment still?
But that's a big risk here. Like right now, I agree with the Reserve Bank governor that wages growth somewhere between 3.5% and 4% is not a problem. It's sort of roughly where it should be on a longer term basis if we're going to have 2 to 3% inflation. But the problem is that if you start chasing higher inflation with higher wages growth, like we saw in the 70s, then you will have a bigger problem. You'll lock in higher inflation. And the reason the minimum wage is important is because if it's granted in the order of, say, 7%, which I think is what the union movement was arguing for, which, fair enough, that's what the inflation rate has been over the year to the March quarter on the quarterly CPI numbers. If you get that, then it doesn't just affect the 2% of workers who get the minimum wage, it affects those on award wages. But 22% being affected there, it has an influencing effect more broadly, and we saw that coming out of the wage increase last year. It has an influencing effect more broadly on wages set by other means. And it's coming at a time when the public sector wage caps have been removed or relaxed in New South Wales and Victoria. We've got the 15% increase in aged care wages. All of these things add up to an environment of stronger wages growth, potentially pushing above the 4% level. And obviously that would concern the Reserve Bank. So, I mean, the way to solve this problem is to get inflation down. We don't want a rerun of the 1970s, 1980s problem where wages chased inflation higher and vice versa, and we ended up with 10% plus unemployment. That would be a total disaster. And that's why the Reserve Bank, I guess, has to sound pretty tough in this environment. And it need be, if we do get a further significant acceleration in the minimum wage growth when the results are announced, yes, the risk is, odds are, they'll probably have to go and jack up interest rates again, unfortunately.
Shane Oliver, Chief Economist at AMP, thanks as always.
My pleasure.